Plus, we're going to be joined by Bob Prechter of Elliott Wave and find out what similarities he sees between now and the stock market crash of 1987. The Dow falling almost 1.5% today. This is on the 20th anniversary, obviously, of one of Wall Street's worst days. But what's next for the markets? For his thoughts, we have David Joy. He is the chief market strategist at RiverSource Investments. And we're joined by Robert Prechter. He is the chief executive officer of Elliott Wave International. He correctly anticipated the 1987 crash, and he joins us this morning from Atlanta. Robert, welcome.
Thanks very much. You know, looking across the networks this week, it seems that somebody raided the Museum of Natural History and brought back out all the old dinosaurs, so I'm glad to be one of them.
Well, I wouldn't characterize yourself as a dinosaur so much, Robert. I appreciate your being with us. Tell us a little bit about what do you see in the stock market right now, and if you can, just put it into some kind of context using the Elliott Wave theory that is really your filter for what's going on.
Right. Well, the main thing that we use is measures of market psychology, and there are all kinds of them, from sentiment indicators to wave structures to cycles. I brought a few illustrations today that I think is going to make what I see here very, very clear. If we could bring up the first one, it's called Dow priced in real money, which is gold. I'm going to show something that very few people realize, which is that there has been a substantial decline in stock values since the 1999 peak in real values. If you look at this chart, it's striking how much people really wanted to own stocks from 1980 all the way up to 1999. It was virtually a period of uninterrupted optimism towards stocks, and that has reversed dramatically in the past 8 years. But I call it the silent crash. No one can see it because of the amount of credit inflation we've had and the drop in the value of the dollar.
Well, let me ask you, Robert, if this is true, does this also account for the price increases that we're seeing, for example, in oil, because obviously priced in dollars? And what do you make of the Federal Reserve's lowering of interest rates? Is that going to dim your view of the stock market even further?
Well, Pim, I think you're exactly right. If you plot the oil in terms of real money as well, you find that it's priced about where it was 7 years ago. So most of this is a tremendous reflection of the amount of inflation we've been enduring in the first decade of the 2000s. If we could put up that second graph, I'll give you a little bit more perspective on this. This is the Dow Industrial Average priced in things. In other words, how much stuff can you buy with your 30 Dow shares? Again, in 2000,